Can you really maximize your income by investing in dividend stocks while the market is in turmoil? In this video, we'll dive into the top 5 dividend stocks to buy, focusing on undervalued giants. With the stock market's dip causing panic, what opportunities are emerging for savvy investors? By the end of this video, you'll discover how these companies are not just surviving but thriving, and you'll learn why now is the perfect time to invest in them for long-term gains. Don't miss out on the chance to make your money work for you. Welcome to Market Reflect. Let's get real. February 2025 was a mess for the stock market. The S&P 500 dropped 1.5%, and people started panicking like it was the end of the world. But guess what? It wasn't. Some YouTubers love to throw around apocalyptic predictions for clicks, but here we stick to the facts. Historically, February is a terrible month for stocks, literally the second worst month since 1928, only behind September. But here's where things get interesting. The Mag 7, those tech giants everyone has been obsessed with, Nvidia, Microsoft, Apple, Tesla, Meta, Amazon, and Alphabet, got hit hard. We're talking about an 8% drop in their ETF mags. Why? Big money investors finally decided to take some profits and rebalance their portfolios. It's not a market crash, it's just the cycle of money moving around. But here's the golden question. Where is that money going next? The answer: dividend stocks that pay you to wait. While the high flyers of the past few years take a breather, smart investors are shifting their focus to companies that generate consistent cash flow. Let's break down 5 dividend-paying stocks that could be your ticket to maximizing your income. First, Salesforce. Salesforce is the overlooked AI powerhouse that just took an unfair beating. The company just had a brutal February. This $285 billion software giant saw its stock drop 17.7% in just 1 month. That's a massive red flag, right? Not so fast. Their earnings weren't bad. The problem? Investors freaked out over the company's guidance. Wall Street doesn't care about what you did. It cares about what you will do, and Salesforce's cautious outlook sent traders running. But historically, this is a company that beats expectations over and over again. For the past decade, they've only missed annual earnings once. And now, the stock is trading near its 200-day moving average, with the next support level at $290. If it falls to $270, that could be an even juicier entry point. Analysts? They're still bullish, with an average price target of $378, which is almost 30% upside from here. Salesforce isn't just another software company, it's an AI powerhouse in disguise. The first wave of AI was all about chips. The next wave? Software companies like Salesforce that help businesses actually use AI to cut costs and boost profits. Second, Amazon, the unstoppable giant that's finally trading at a discount. Amazon is one of those stocks that people always say they wish they had bought earlier. Well, congratulations. Now might be your chance. The company's stock dropped 11% in February, and year-to-date, it's down 3%. Not exactly the disaster some headlines make it out to be, but here's what's important. Amazon's earnings were solid. The problem? Their guidance was weak. Sound familiar? It's a classic strategy. Companies lowball their expectations early in the year so they can beat them later. This happens all the time, especially when there's uncertainty around a presidential election year. Now, let's talk numbers. Right now, Amazon is hovering around $200 per share, a major support level that's also near its 200-day moving average. Oh, and the RSI is sitting at 30, meaning it's officially an oversold territory. Wall Street still loves Amazon. 0 analysts have a sell rating. Only 1 has a hold rating. And their 12-month price target? $269 per share, a 30% potential upside from here. Third, Nvidia. Nvidia's dominance is undeniable, but is this a rare buying opportunity? Nvidia has been the golden child of the stock market. Over the past 2 years, it has skyrocketed 82%. But even kings need a break, and Nvidia is finally catching some selling pressure. Year to date, it's down 7%. Sounds scary? Maybe. But let's look at the facts. The company's earnings were strong, and unlike Amazon and Salesforce, Nvidia actually beat guidance expectations. The issue? Growth rates are slowing. Well, duh, you can't grow at 100% forever. The stock is holding above $115 per share, which has been tested twice in February. If it breaks that, we could see a drop closer to $100, which would be a screaming buy. Analysts are still all in on Nvidia. The average price target is $180, meaning 40% upside from here. Zero sell ratings. The only real risk? The fact that hyperscalers like Amazon and Google are building their own chips. But that's a problem for future Nvidia, not today. Fourth, PayPal. PayPal is the forgotten financial giant that's quietly making a comeback. The company has been beaten down for a while, but that might be about to change. This $70 billion company has been working on two major catalysts: less regulation under a Trump presidency, and finding ways to actually make money from Venmo. But here's where things get spicy. PayPal just announced a $15 billion stock buyback. That's 20% of its entire market cap. Translation: they're using their cash to buy shares at these low levels, which should boost the stock price over time. Right now, PayPal's stock is sitting at $67 per share, a critical support level. And its RSI is below 30, meaning it's officially oversold. Analysts have set a 12-month price target of $95, meaning 34% upside. And guess what? Zero sell ratings. And fifth, Merck, the steady healthcare leader that rewards patient investors with dividends. Merck isn't a flashy stock. It's not making AI chips or building electric cars. But what it does have is one of the best-selling drugs in the world, Keytruda. The stock is down 28% over the past year and 7% year-to-date. But here's the thing. This is exactly what happened to AbbVie when Humira's patent was expiring. Investors panicked, the stock tanked, and then it rallied 40% once the dust settled. Merck's Keytruda patent doesn't even expire until 2028. That gives the company years to figure things out. And while you wait, you get paid a 3.6% dividend yield, which they've increased for 14 consecutive years. The stock is finding support around $80, and with an RSI below 30, it's flashing a big buy signal. Analysts have a 12-month price target of $115, meaning 25% upside. So, what do we have? A software giant that's unfairly punished, an e-commerce titan on sale, the king of AI chips with temporary weakness, a financial stock with massive buybacks, and a healthcare company paying a juicy dividend. This isn't just about playing defense. This is about getting paid to wait while the market corrects itself. And when it does, the money will already be working in your favor. Which of the 5 dividend stocks do you think has the most potential for growth, and what factors are driving your choice? We'd love to hear your analysis in the comments. And that's it for today. Hit the like button and subscribe to Market Reflect. Stay tuned for more and catch you at the next one.